requires SEC registrants, including banks, to include on their balance sheets crypto assets that are custodied on behalf of their clients. Requiring banks to place custodied digital assets on their balance is a shift, as Chairman Powell recently noted, in historical practice, as custody assets have always been treated as off-balance sheet. SAB 121 changed that, and I'm concerned about the consequences because banks have capital, liquidity, and other prudential requirements that non-bank custodians do not have, meaning that banks cannot offer digital asset custody services at scale without significant balance sheet implications. If banks cannot provide digital asset custody services at scale, they simply will not offer those services, which could lead to market participants not having bank-grade custody solutions to pick from and will turn to offshore solutions, like in the Bahamas, diminishing American competitiveness and compromising investor protection. Chairman Gensler, has it occurred to you the irony that at the same time you pursued SAB 121, which has effectively precluded highly regulated banks from offering customers the safety and security of segregated digital asset custody services, not a single one of the 4,500 employees under your supervision at the SEC noticed that FTX was allowed to commingle customer funds, allowed FTX to trade, settle, custody, lend, and borrow digital assets without institutional-grade custody?
I'm actually quite proud of the staff that put out that staff accounting bulletin, because what they said is that public companies, not just banks, but that public companies needed to put on their balance sheet if they had their customer crypto. And it's what we've subsequently found in bankruptcy court, Celsius bankruptcy and others, that in bankruptcy, investors just stand in line.
Well, reclaiming my time, did you or your staff consult with prudential bank regulators? Was there any interagency interaction on SAB 121 before or after this was issued in March of 2022, given the ramifications that this effectively prevents well-regulated banks from providing digital asset custody services?
There was significant dialogue beforehand with accounting professions at the Big Four and others, because this question kept coming up, but there has been consultation about this with the bank regulators subsequently.
Well, I find it very interesting that nobody at the SEC, under your supervision, noticed that FTX, a one-time $32 billion company, was run on QuickBooks. Private funds rulemaking. You have repeatedly stated that increasing competition in the private fund market is one of the primary objectives of your proposal. But last week, the Committee on Capital Markets Regulation issued a competitive analysis of U.S. private equity fund market. Its key findings: concentration is very low and 4 times lower than the concentration of the public mutual fund industry. The number of fund advisors and funds is steadily growing. The range of investment strategies available to investors is increasing at a significant rate. Barriers to entry are low. Effective management fees have been declining. Performance net of fees and portfolio diversification benefits outmatch that of public markets. Demand from investors is growing. This analysis directly refutes the entire basis of your rulemaking, that there is a lack of competition in private equity. Indeed, your proposal will have the exact opposite effect: reduce competition in U.S. private funds markets, including disadvantaging newer and smaller private equity advisors and decreasing the number of investment opportunities available to investors. When you contend there's a need for greater competition in the private funds market, what specific evidence are you relying on?
Just looking at this field and what the limited partners came to the SEC and did various filings with us saying they needed greater transparency about fees, about performance, and about the side letters, and particularly the side letters, because the fund managers are cutting special deals. If I might just say on the earlier point on crypto, if these companies had registered, we'd be able to look at their books and records. But when they don't register, the only tools we have is actually investigative.
Well, reclaiming my time and back to private funds, you know, the United States has only 4.4% of the world's population, but 50% of the capital is raised here. And Europe, by contrast, has the same population, but less than 20% of the capital raised here. The difference between us and Europe, and I want to stay the U.S., not Europe, is that we diversify our markets with private capital being a big driver, making credit easier to obtain for all Americans, making investments in tech, in healthcare, biotech, manufacturing, higher paying jobs. So when you analyze proposals to change our capital markets, don't forget to recognize we've got a much better system than Europe. Let's not be Europe. Yield
The
back.
gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you, Chair Gensler, for joining us today for this critical hearing. Although I wish it didn't have to be repeated, I know there are some who deny this fact, so I just want to reaffirm that climate change is real. It is here, and let's be very clear that our constituents' investments, whether it's their personal retirement savings or college savings for their children, are at risk. The good news is the SEC's proposed climate disclosure rule would help protect investors by requiring companies to disclose their exposure to climate risk. Although the cheerleaders for big oil want to weaken this rule, the consequences are clear. Without a comprehensive climate disclosure regimen, we will fail working class people throughout our country, and we will fall far behind our global partners. Chair Gensler, you mentioned earlier that during the comment section that there were thousands of investors that commented favorably, correct, on the proposed rule?
That's correct. I think we've gotten 15,000 comments, and on the investor side, it's almost uniformly supportive of mandating climate risk disclosures.
Right, they were overwhelmingly favorable. So for those watching at home, I just want to get into the details to better explain why they were so overwhelmingly favorable. There are 3 categories of greenhouse gas emissions. Scope 1 and 2 emissions result from a company's operations, for example, the pollution from a company vehicle or their use of electricity generated from fossil fuels. And then there are Scope 3 emissions, which are the biggest category, making up on average 70 to 80% of a company's carbon footprint. These are resulting from indirect ops, which include the entire business model, including emissions produced by suppliers and also from consumers using the company's product. Big Oil is fighting to get rid of Scope 3 emissions disclosure from the SEC's proposed rule because in a world without transparency, they can gravely misrepresent their exposure to climate risk and rake in millions of dollars. If oil companies like Chevron reduce their Scope 1 emissions by switching to electric vehicles for transportation, and their Scope 2 emissions by installing solar energy at their headquarters, then they could technically claim to be net zero, even if they continued selling fossil fuels as their core product. Chair Gensler, if you were an investor looking at climate transition risk in your portfolio, do you think that looking at an oil company's Scope 1 and 2 emissions alone would give you an accurate picture of your risk exposure?
Well, in my personal portfolio, I'm only allowed to be in index funds, but in terms of, or broad-based funds, but what we've learned is many of the comments we received from actual investors have said they would like to have better consistency around this greenhouse gas emissions, including some estimate about their supply chain.
Right, the people want to see Scope 3 disclosures. The European Union and other countries around the world are implementing new disclosure rules that include Scope 3 emissions in the next few years. Now, some argue that reporting is too burdensome, but 70% of U.S. companies will be reporting Scope 1, 2, and 3 emissions within the next few years, regardless of what the SEC does. So let me make it plain. This is not the time to backtrack and to weaken regulations. Now is the time for action and to put people over polluters. Thank you, and I yield.
The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chairman. We've seen a troubling, and I'm from Texas, I need to tell you this, so a lot of this conversation doesn't ring well back where I live, but we've seen a troubling trend with current administration who continues to call for more government regulations and push an anti-growth green agenda. The SEC's climate risk disclosure rule would have major consequences for the businesses across the country, especially smaller entities who lose out on opportunities because they cannot afford the increased compliance costs that come with burdensome regulations like these, and we see this administration continue to put the pressure on small business. An economic analyst of the SEC's climate proposal estimated that compliance associated with these requirements could cost over $100 million for certain companies. This would be detrimental for companies and will stifle innovation and businesses' ability to grow. So what is the SEC's legal authority to enforce these climate-focused regulations, and how does the SEC plan to ensure that its climate disclosure rule does not disproportionately harm smaller entities? I'm a business guy in Texas. I'm a small business, which may lack the resources and expertise to comply with the rules reporting requirements.
Let me take your second question first,
Okay.
if all right. Our authorities are just about the public registrants, these 7,000 or 8,000 companies. And we're not placing any obligations on non-public companies, companies that aren't raising money in, like, on the New York Stock Exchange. In terms of the authorities, we're staying right within those authorities I talked about earlier that Rayburn and Roosevelt wrote. It's about describing the business, putting it out there, the full and fair description, including the material risk, and investors today are making decisions based on climate risk disclosures. So it's trying to bring some consistency to that, but we are not a climate regulator,
Okay.
and we're neutral about that.
So following up on this previous question we talked about, is it clear that your climate proposal will undoubtedly impact private companies who cannot shoulder the increased costs that would come with collecting and providing data obligated by this rule? This is not making our public markets more attractive to companies trying to break into the market. And this rule's unnecessary information requirements will subject companies to public scrutiny, investor pressure, and increased regulatory burdens. So this will use valuable company time and costly resources. And we see this on Main Street with the regulations that Biden administration has put on businesses. So we'll see it in costly resources that business owners could otherwise be using towards raising capital, growing business operations, quite frankly, hiring people and put people to work. So can you discuss the impact that increased reporting requirements and the associated costs will have on attractiveness of our public markets and private companies' decision to go public and grow?
I think those public companies already are making significant disclosures about climate risk. And I think that what we can do is help bring some consistency, also ensure for those companies that are public that consistency helps them against some that might be making bold claims, what one might call it greenwashing and the like, and help them tell their stories in a consistent way. And as the representative said earlier, Europe also is requiring things. So it will help us be recognized by Europe, hopefully to be that our rules would be recognized by them rather than their more restrictive rules.
Yeah. All this coupled with interest and regulations are killing Main Street American small businesses. Now, by calling on, my last question, by calling on more stringent ESG regime, we are trying to turn the many economists and financial experts at the SEC into environmental scientists who will force companies to adhere to a moving target of climate change goals coming from whichever party controls the White House. As the materiality standard definition continues to be threatened by your agency, I'm concerned that everyday investors will ultimately be hurt by activists who might be the loudest in the room but are not personally invested in many of these companies. So, Chairman, how will you ensure that investors are not going to be pressured and harmed because of activists pushing their agenda into a space where they do not care about any individual security? Can you commit to materiality limitations?
Materiality is a bedrock of our disclosure regimes, and that's in the context of what basically, as the court says, a reasonable investor would find significant in making their investment decisions.
Okay, I yield my time back. Thank you.
Gentleman from Illinois, Mr. Foster, is now recognized for 5 minutes.
Thank you, Madam Chair. Well, first off, I just want to thank you for your work, and I do believe that there should be a rough proportionality between the number of rulemakings and the number of good ideas, and there's a backlog of good ideas, and many of which you're really following through. I am worried about sort of the overload, both on your staff and on industry participants on this. I think, for example, the economic analysis, when you have multiple multiple rulemakings coming in at once and trying to understand how they'll talk to each other and interact with each other is a complicated thing. And I see a huge merit in pilot programs, particularly as regards to market structures on this. That if you just hived off 10% of the markets and tried your new auctions on those, for example, and see if what to me is the bottom line is the quality of order execution for retail traders. That's pretty close to my economic bottom line. And I'd also like to commend you on your approach to 605 in terms of it needs to be updated. And providing retail investors some idea of what kind of quality of order execution they get when they switch to different platforms, I think is the right answer. But I'm a little bit leery about having a new complicated reporting requirement for all the different market participants. There is one entity that has all the necessary data. It's the consolidated audit trail. And running some standard agreed upon open source version of the software on the consolidated audit trail, some lagged version of the consolidated audit trail, I think would get that information in a form that would be digestible. So if you I could just have your reaction, first off to pilot programs, and secondly to the technical implementation of measures of execution of order quality.
We put out the 4 proposals in December, and I think that they address separate important parts of the market. In terms of the 2 that you mentioned, the updating of a 23-year-old rule so that the retail public, the individual investors can get better information on execution quality, I think is what you call it, 605. I'm glad to hear you're supportive of that. In terms of the auctions that we proposed, this order routing rule that we proposed, that was really to help individual investors get better execution and get more competition with regard to their execution.
Yeah, but it's not blindingly obvious, at least to me, that they're actually going to get better pricing. You know, this sort of cockamamie system that we have right now does allow a retail investor to sort of raise up his hand and say, look, I'm clueless. Will you give me a good price to trade against me because I'm documented to be clueless? If you understand,
Well, actually,
low toxicity of their order flow is, I think, the buzzword.
I like to think that the individual investor is pretty smart, but the individual investor is only trading small amounts of stock, and so there's a sweetness in the order, and it's trying to get competition for that sweet order because it's small.
Yeah, but right now, your system, as I understand it, might take away his ability to sort of monetize the sweetness of his small, clueless orders.
I actually think, and again, it's only a proposal. We're going to consider all the comments that come in, but it's trying to get even greater competition. It's saying that order could go straight to a lit exchange. That'd be fine. That order, if it can get at least mid-market, half the spread, that would be fine. But if it's less than that and not on a lit market, put it out to some competition.
Yeah, and then so a pilot program would reveal that, is, you know, the main point I'm making, that if you do this, you should see better, you know, hive off 10% of the market, try your auctions, and see if the order execution quality is better. It seems straightforward. I'm a scientist and a big fan of data. You know, nothing is more joyful as a scientist than to prove the theorists wrong. And you have theoretical calculations that should save money, and you should be able to prove it with a pilot program before you expose the whole market to it. Let's see, you sort of touched on crypto, and one of the lessons, it seems like if you're going to prevent wash trades, you need to know the true identities. Some regulator somewhere has to know the true identities behind market participants. And have you found any way in the crypto business to reconcile sort of the crypto libertarian point of view with the absolute necessity to know the true identities to prevent wash trades, or are wash trades the price we pay for crypto?
It's to get the intermediaries, the storefronts, to register, and then we could get the data from those crypto exchanges themselves as to where the buy and sell orders are coming from.
All right.
Gentleman's time's expired. The gentleman from Minnesota, Mr. Emmer, is now recognized for 5 minutes.
Thank you. Chair Gensler, I have a lot of questions and a limited amount of time, so if you could keep your answers to either a yes or a no, that will allow us to get through as many as possible, sir. From your perspective, is it more difficult now for the digital asset industry to access financial products and services in the United States than it was, say, 2 years ago?
Sir, I'm not running one of those businesses. If they came into compliance, I think that would
Reclaiming
be
my time. The answer, sir, is yes. Do you think you and the SEC have had a role to play in that?
I think we have a role to protect the American investor and the capital markets and the
Reclaiming my time, sir. You have played an obvious role in that. During your tenure at the SEC, how many rules has the SEC finalized that actually accommodate the existing regulatory framework and are specifically to the digital asset industry so the crypto market can come into compliance?
It's their rule books that are on the books for years, so we have not finalized any new rule specifically with regard to crypto. We've proposed some things in best execution. We've also...
Sir, reclaiming my time, the answer is 0. And how many enforcement actions has the SEC levied against digital asset companies during your tenure, sir?
I think it's probably 40 or 50.
The answer, sir, is about 55. My understanding is that the biggest crypto failure in history is probably FTX at $9 billion. Were you the chairman of the SEC when FTX collapsed?
Yes.
And how many times did you meet with FTX prior to their collapse?
I think my public record shows 2.
You met it with FTX at least twice. And arguably, the second biggest crypto failure in history was Terra Luna. Who was the chairman of the SEC when Terra Luna collapsed, sir?
We had brought...
You were, sir. Reclaiming my time, you were. There are 5 members on the commission. Do you believe your speeches and interviews are to serve as the official position of the SEC?
I can only speak for myself when I'm speaking.
Again, sir, in a statement on the SEC website, you are quoted saying, the Kraken staking as a service enforcement action should make clear to the marketplace that staking as a service providers must register. But again, you haven't provided any rules for how that can be done. I must remind you, your public statements are not regulations. It's not responsible to expect the American people to assume your statements are a substitute for rules. Do you agree with this statement regarding the digital asset industry? The SEC needs additional congressional authorities to prevent transactions, products, and platforms from falling between the regulatory cracks.
I think that it's a largely non-compliant field. And
Sir,
we could use
again,
additional
I asked you to comply with my questions, and I'm asking you if you agree with that quote. And I'm going to tell you, I'm quoting you from an August 3rd, 2021 article where you, and I believe you told Congressman Hill earlier that you need congressional authority to regulate stablecoins, and stablecoins happen to be a significant percentage of the crypto market. So the question is, when were you telling the truth? To Mr. Hill or to me? You've got to start answering these questions in a more transparent manner, sir. Does it concern you, by the way, that your approach to the digital asset industry is actually driving this industry out of the United States?
We're trying to drive it to compliance, and if they're not complying with the laws, then they shouldn't be offering their products.
Reclaiming my time. Madam Chair, I would like to enter into the record this Wall Street Journal article from April 14th, 2023, detailing China's ploy to open its banking system to crypto firms in an effort to seize an opportunity created by our hostile regulatory environment, which, Mr. Chair, you're a big part of.
Without objection.
Chair Gensler, FTX was domiciled abroad and so is Binance, yet American consumers still had access to both. You can't really think that pushing this industry abroad is going to protect American consumers when it hasn't several times in the past on your watch. You say the crypto market is rife with non-compliance. However, existing SEC rules make no sense for blockchain-based companies, and following them would actually kill these businesses. Your regulatory style lacks flexibility and nuance, and as a result, you've been an incompetent cop on the beat, doing nothing to protect everyday Americans and pushing American firms into the hands of the CCP. Your intention to work against SEC mission and put American investors in harm's way has been made very apparent, sir. It's been a year and a half since you've appeared before this committee. You need to answer to Congress about the issues that you've had with the SEC staff union, the work environment you've cultivated at the SEC that's led to hemorrhaging of senior staff, the intellectual inconsistency of your regulatory treatment towards Bitcoin spot ETFs, and your politicization of capital formation opportunities
Gentleman's
through your
time's
treatment of
expired.
certain SPACs. And that's just to name a few. Thank you. I yield.
Gentleman from New Jersey, Mr. Gottheimer, is now recognized for 5 minutes.
Thank you, Madam Chairwoman and Ranking Member Waters. Mr. Gensler, thank you for being here today, and thank you for your leadership on many fronts. I'll try to take a breath here, but I have a couple quick questions. I've shared with you my concern with the unusually short-fused, overlapping, rushed, and zone flooding rulemaking under the SEC, and undermining my fear that it undermines the public's ability to provide thoughtful feedback on the proposals of the Commission and risk stressing an already tenuous economic climate. The SEC's Inspector General raised concerns with this aggressive and rushed approach to rulemaking in a report last October, and raised concerns the SEC has staffing issues that may affect the quality of the rulemaking given these short fuses. Some of these proposals are necessary, obviously, to protect investors, and I want to make sure they see their way through and to ensure stability in the financial markets. But I'm concerned that doing it in this manner, it's sometimes hard to tell the impact these rules will have collectively on the economy, on jobs, on certain key job-producing sectors in my state of Jersey and the tri-state area and nationwide. Since you've taken the helm of the SEC, 27 of the Commission's 53 comment periods have had a highly unusual comment periods, shorter than 45 days from the date the proposal was published in the Federal Register. Considering the delay between when rules are posted on the website and when they are posted in the Federal Register as part of the comment period is not only consistent, it strays from the historical practices of the SEC. These proposals collectively total more than 4,000 pages with more than 2,500 questions to respond to. Last year, it took a letter from 47 members of Congress to get you to extend a 30-day comment period on a 300-page rulemaking with more than 900 questions. Many of the proposals put forward by the Commission in the last 2 years affect the same stakeholders who've repeatedly requested additional time, especially small businesses and other smaller players in the space, to respond to the SEC's often overlapping and rushed comment periods. And I'm concerned that limited stakeholder engagement, especially from small businesses without large regulatory teams to respond, will lead to unintended consequences that will ultimately harm American consumers. Have you at any point been concerned that by moving this hastily, that it could really hurt smaller market participants and their time to provide feedback?
I'm very proud of what we've done. We put out 46 proposals to date. We've reopened some, so that may be why this other numbers floating around this hearing. And on average, it's been more than 70 days from the time we voted out, we put it on our website, and we have a formal end to a comment period. But then we get comments after that, and we take meetings after that, and we engage actively with trade associations and market participants.
My only concern there is when, it doesn't actually count when it goes on a website because there's no formal comment period on a website. It's the Federal Register, when it goes to the Federal Register is what the standard is. So
with all respect, people can read it, people can start to do their analysis, they can engage with staff or with their trade association members.
So they can start submitting comments as soon as it goes on the website? Is there a way to do that? Formal comments?
They tell us that they want to have time to read what we do. We put it out. It's very transparent. And we also often consider comments well beyond that period of time and continue to receive comments. On average, it takes 12 to 15 months from proposal to considering an adoption. And so,
but the comment period closes.
Transparent.
But the comment period closes during that time, right?
But we continue to have meetings, we continue, and the staff and the commission is able to consider, just like this hearing right here is going to influence me as a decider, a decision maker on that commission.
Thank you. I'm just going to reclaim. Yeah, if I can just come back to this, I'll shift gears. Since 2019, I've pushed this committee and financial regulators to create smart guardrails for digital assets. You've repeatedly claimed that most cryptocurrencies are covered by existing securities law, and despite that belief, the Commission has issued little formal guidance to facilitate digital asset firms' compliance with existing rules. The SEC, under your leadership, has largely used enforcement actions to spur compliance. I'm concerned the lack of formal guidance through the normal rulemaking process is spurring even more uncertainty in the space, hurting our global leadership in financial technology and putting consumers at risk and further enabling bad actors. The SEC's advisory committee urged you to solicit comments on federal securities law regulation to crypto assets. you plan to take their advice and go through a public rulemaking process that allows regulatory changes in the appropriate manner versus just
We have, Congressman, in a number of areas. The best execution rule that we put out last December includes a whole section on or crypto assets, if I might. We're updating our custody rule, and we put out a lot of words and important economic analysis. And last Friday, we did the same on an expanded definition of
Do you feel, before I
exchanges.
lose you, do you feel like you have all that you need from us, to all the laws you need to be able to do what you need to do?
Yes,
on
as it
fintech?
relates to crypto assets, and to the earlier question, I do also, though, support Secretary Yellen's initiative about stablecoins.
Thank you so much. I yield back.
The gentleman from Georgia, Mr. Loudermilk, is recognized for 5 minutes.
Thank you, Madam Chair. Thank you for being here today. I've got a lot of concerns. I'd like to continue on a little bit in the direction that my colleague from New Jersey was going on the number of rulemakings and how you have fast-tracked a lot of these, limiting public comment period. I've heard you say in here that you support congressional oversight, and you respect it, but from what we've seen, your actions are different than what your words are saying. You've shortcut a lot of the Administrative Procedures Act in your rulemaking. It appears that what you're wanting to do is hurry things along before Congress can have its due oversight. Excuse me. But what I want to talk about is something that I have not been in favor of, and I've opposed ever since it was proposed, which is the consolidated audit trail. I know Mr. Hill asked you some questions about that. First of all, I've never been supportive of it, but it's here, and we have to constrain it. I believe it's a violation of the Fourth Amendment, of right to privacy of individual investors. Let me put it in the words of the American Securities Association, and they described it of how the collection of this data violates the Fourth Amendment right to privacy because it forces every investor's financial information, personal information, and transaction history without any evidence of wrongdoing. And I want to quote in a letter that they have sent to this committee, both the ranking member and the chairman, is that tracking unsuspected and unsuspecting Americans' every move in hopes of finding unlawful activity is not consistent with the principles undergirding the Constitution, which is true. In fact, a lot of information that we see that regulators are forcing independent financial institutions to divulge about their investors or their bankers or those that do business with them. If law enforcement was trying to derive that information, it would require a search warrant. But yet the federal government will come in and they'll force that information out of these individuals. I spent a lot of time in the military dealing with security, information security. I had 30 years in the information technology sector. What I see in industry is a decentralization of information because of the risk of disclosure. Blockchain, many industries are going to blockchain because you're no longer centralizing it. When it's centralized, there's a one-stop shop for the bad players to come and get information about individuals. So my first question is, what do you believe in this? Is it easier to protect decentralized investor information held by thousands of firms, or do you feel it's more secure to centralize that in a database administered from Washington, D.C.? Which do you feel is more secure?
There's risk in both sectors. There's risk in the decentralized, there's risk in the centralized. It's really about the appropriate data security in that database. And this is a debate that technologists have quite often. The consolidated audit trail is important to help surveil the market, to oversee the markets. Data was being collected before.
So surveil the markets. So you're looking to use this as surveillance tool of the markets to enforce regulation, or what's the purpose of consolidated audit trail?
To help oversee the markets, to protect against fraud and manipulation, front-running, insider trading.
Without any just cause? Or, I mean, are you just randomly going to look? Maybe somebody's doing something wrong here, and I've got all this information. But let me tell you, there is no one in the information systems industry that's worth their salt that will tell you it's more secure to have information at one point, one-stop shop. So if I'm a bad guy, I'm a foreign player, I've only got one spot to go to pull all this information. I'm going to put all my investment, all my technology in breaking your security to get that information versus thousands of places that I do not have the resources to do that. Centralizing is a security risk. Now, one of my questions here, will the consolidated audit trail and the case databases collect personal financial information of American retail investors? Are you going to collect information on individuals who are using platforms to invest? Are you going to collect that information?
So you're right, there's two databases. The case database will not have individual, their names, their birthdays, and so forth, but it has to have an identifier so that it can be tagged back to what the broker-dealer has.
What about
Gentleman's time's
consolidated
expired.
audit trail?
Gentleman's time expired. Perhaps you can answer Chair Gensler in writing. The gentleman from New York, Mr. Meeks, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Gensler, for coming to testify today. Now, when you appeared before this committee in 2021, I asked you about your commitment to improving the SEC's diversity disclosures, empowering investors, and encouraging greater corporate diversity, especially within America's boardrooms and among senior management. And you mentioned your focus at that time on human capital rulemaking, which would include such disclosure improvements. And I understand that a proposal should be coming out within the next few months. Now, what concerns me, however, is much has happened since 2021, including efforts by some on the extreme right wing, like Florida's Governor Ron DeSantis, to politicize diversity, equity, and inclusion efforts and attempt to ignite his own, I guess, presidential campaign. Now we have well-intentioned companies in states like Florida trying to make improvements to their policies who find themselves at odds with the leadership of their state. It's also disappointing since there is evidence, strong evidence, that improving corporate diversity can be a bipartisan issue. This should not be a partisan issue. For example, my board diversity bill received the support of 55 of my Republican colleagues right here on the House floor in 2019. So we passed it with the support, a bipartisan support with my Republican colleagues, many of whom sits on this very committee. So given the attempts by Governor DeSantis and others to curtail DEI efforts in academia and corporate America, I have two questions related to your human capital rulemaking work. Is the SEC considering how state-level efforts to hamper DEI-related programs could make it harder for companies to comply with more robust human capital disclosures, which we expect from the SEC?
We consider the law, the federal law, but certainly if you have things, and we maybe have staff follow up if there's something at the state level that you want to flag for us and help us sort through in terms of any of our rulemaking, but particularly with regard to human capital management. But we try to do our best to stay within the law and how the courts interpret our laws.
Yeah, so, what I'm concerned about are there things that the SEC can do in your human capital rulemaking so that you can shield public companies looking to do the right thing with respect to DEI and disclosure from state-based legal challenges? Or at least will the SEC seek public comments on this question?
Well, in all of our rulemaking, we seek public comment on our authorities because we want to, of course, stay within our authorities, but our disclosure-based authorities, again, we're merit neutral, and that's because Congress chose that we needed to stay that. But it's the disclosures for investors to best understand the companies they're investing in as it relates to human capital, that they could best understand that most important asset of the company.
And I couldn't agree with you more. And I think that's good policy. That's why it should be bipartisan. And that's why it has been bipartisan previously. So I'm just hoping that states, like what's happening in Florida, doesn't occur or affect what you're trying to do on an equitable basis, just giving investors the information they know. Let me do real quickly, see I'm running out of time. You know, I know I want to touch on crypto regulation. As you are aware, our regulator in New York, the New York Department of Financial Services, has created a first-in-class bit licensing regime for virtual currency businesses, which we are very proud of. What I'm afraid of, some are saying that they may take businesses throughout this country abroad and get regulated someplace else. What say you on that?
I say if they're complying with the laws and doing the right by investors, they can be here, but if they're not complying with the laws, investors will get harmed.
I'm out of time.
The gentleman from West Virginia, Mr. Mooney, is now recognized for 5 minutes.
Thank you, Madam Chairman. The Securities and Exchange Commission may be the agency that most directly threatens the livelihoods of West Virginians today. I never imagined I would say that because American presidents are not supposed to so brazenly weaponize the SEC to push through radical climate change policies that they're unable to pass through Congress. When the Obama-Biden war on fossil fuels was first launched in 2009, coal mining gainfully employed nearly 28,000 West Virginians. Today that number has shrunk to 14,000, a 50% decrease. And the SEC has proposed a crippling climate disclosure rule to mandate all sorts of detailed emissions data for public companies and many non-public companies. The SEC already requires the disclosure of material information to its investors, so let's not kid ourselves and say it's about materiality. SEC Commissioner Hester Peirce put it best when she stated, quote, although styled as a disclosure rule, the goal of this proposal is to direct capital to favored businesses and to advance favored political and social goals. In other words, it's about naming and shaming fossil fuel companies. Some estimates suggest this disclosure rule could cost companies over $100 million to comply. So, Chair Gensler, the SEC Inspector General issued a scathing report saying you were rushing through rules without adequately considering the costs. So can you tell me today how many jobs this climate disclosure rule will cost West Virginia families?
Again, sir, we're not a climate regulator and we're merit neutral. This is about companies are already making disclosures and trying to bring some consistency to that disclosure. That's what it's about, is, with all respect, not about something further than that. In terms of the economics, it's really about ensuring that investors get the benefit of those disclosures. And if they want to go long West Virginia coal, they have the right information long means to purchase companies that are public companies, and it's only about public companies, again.
Well, thank you. Despite your assurances, I think it's clear this rule will be devastating to my state of West Virginia. I'd like to submit for the record, Madam Chair, the Inspector General's statement on the SEC's management and performance challenges. Madam Chair, I'd like to submit for the record the Inspector General's statements on the SEC management and performance challenges.
So ordered.
And I would also like to submit, thank you. I'd also like to submit for the record an op-ed I wrote for the Washington Times on the SEC's climate disclosure rule.
Riveting, without objection.
Thank you. I do have a couple more questions. Chair Gensler, how many climate scientists does the SEC employ?
We employ economists that are more general economists. So some of them might have some knowledge, but I just think of them as market economists and financial economists.
Okay, second, another question, and it's a yes or no one. Would you agree that Congress is better suited than the SEC to enact climate policy?
I'd say it more straightforward. We're not a climate policy agency. We're a market regulator, and it's about full and fair and truthful disclosure about public companies.
Okay, we'll go with the yes or no again. Do you yes or no, does the SEC have the legal authority and expertise to enact climate policy?
We have the legal authority to enact rules about disclosure about risk, and climate risk is something investors today are investing in. So it's just about authorities, about disclosure, about these material risk in the financial companies, in companies that are accessing the financial markets.
Okay, but it sounds like you'd agree the SEC doesn't have the legal authority to enact climate policy then.
We're not a climate policy agency. We're a market regulator and a disclosure-based regulator for public companies.
Well, I ask because this rule is designed to choke off capital from politically disfavored sources of energy. Let me be clear in my last 30 seconds. The SEC has no business enacting climate policy, which is exactly what you're doing. No matter what changes are made to this proposed rule, it's rotten to the core and should be rescinded entirely. The SEC and the Biden administration must end its war on fossil fuels and return to focusing on the needs of investors, not activists. Thank you, Madam Chair. I yield back.
The gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Mr. Gensler, there are areas on which we do see eye to eye, like the need to disclose climate change risk or the need to understand the immense implications of the unfolding AI revolution. But I'm going to offer, however, observations about 3 areas about which I've heard concern, and then have you respond as you see fit. First, on the subject of crypto. The lesson learned from the collapse of FTX is that companies that bear the characteristics of FTX, offshore, deregulated, over-leveraged companies, have the greatest risk of losing customer funds. In a world of scarce enforcement resources, one would think that the SEC would prioritize enforcement actions against high-risk companies that resemble FTX, offshore, deregulated, over-leveraged companies. Instead, it appears the SEC has done the opposite. Instead of targeting an offshore, deregulated exchange like Binance, you've chosen to target an onshore regulated exchange like Coinbase. Instead of targeting an offshore deregulated stablecoin issuer like Tether, you've chosen to target an onshore regulated stablecoin issuer like Paxos. It seems like your enforcement priorities ignore the lessons learned from the FTX failure. Second, on the subject of equity market structure, if a broker sends a retail order to an exchange, the broker would be in compliance with your proposed rule. But if the broker sends the retail order flow to an off-exchange wholesaler, the broker would be out of compliance with your proposed rule, even if the wholesaler is offering a better price than the exchange. And therein lies what seems to be the perversity of the proposed rule. It strikes me as perverse to tell a broker that you cannot send retail order flow to the wholesaler who is offering a better price and therefore a better execution. On the third subject of private funds, both New York State and New York City retirement systems are heavily invested in private funds. The New York State Common Retirement Fund invested about $29.5 billion in PE, and over the course of 10 years saw an annualized return of 10.12%. The New York State Teachers Retirement System invested $14.7 billion, and over the same period saw 16.6% in annualized returns. The New York City Employees Retirement System invested $6.5 billion, and over the course of 10 years saw an annualized return of 15%. So when I see returns as high as 16.6%, which seem impressive, there's a question that comes to mind: does the SEC risk fixing what ain't broken? So those are 3 observations, and you're free to respond.
I thank you, and let me try to do them in kind. In terms of crypto, you're right that U.S. investors are accessing the crypto markets, both onshore companies and offshore. Our jurisdictional reach is to both, if they're U.S. investors that are participating in that.
But let's be clear, you have the authority to take enforcement action against offshore deregulated exchanges.
We do.
and
It's-
Stablecoin
it-
issuance.
It takes longer to build the investigative files. It takes longer, sometimes in cooperation with offshore enforcement authorities to pursue that. And it is frankly more challenging to actually get subpoenas complied with. And so it takes longer in time. In terms of your second area about the efficiency in the capital markets, one area is these individual investors and individual investors placing, as you described, these market orders. And what we did was put out a proposal and said, if that proposal is getting at least the middle of the market, at least mid part or better, it's fine. But if these individual small dollar orders were not doing that, either they're sent to a regulated exchange or put it into competition. But we're going to get feedback on it. And it's one of the 4 rules we put out. It might be the one that I think we've gotten 5,000 plus comments on already.
I just, maybe I'm missing something, because you hold the exchange as the gold standard of competition, but if the wholesaler is offering price improvement relative to the exchange, like, I'm failing to see something.
So one of the things is...
Like, if the wholesaler were offering a worse price, then I would consider that a failure of competition, and I would see the reason for your rule. But if it's offering a better price, are we fixing what ain't broken?
Well, so we don't have a level playing field right now between the dark markets that are probably a third to a half of the market on any given day and the...
But what you denounce as the dark markets are outperforming what you consider the gold standard.
Well...
So that's where I'm confused.
So I'm saying that the dark markets actually have different rules of the road. They don't have the same minimum increment.
I could speak to you for an hour, but
So we're trying to harmonize that. On your last...
Gentleman's time's expired. The chair now recognizes the gentleman from Ohio, Mr. Davidson, for 5 minutes.
Chairman Gensler, in advance of today's hearing, did you coordinate acceptable responses with Senator Elizabeth Warren?
No, I'm speaking on my own behalf.
Did you coordinate with Democratic staff? And I ask because it happened before, and I want to be clear whether you operate of your own accord or whether there's some sort of coordinated approach to the damage that you're inflicting on America's capital markets.
I'm here as sitting in my role as chair of the agency, but I speak and I get remarkable support by SEC staff.
All right, well, I have a few quick questions where a yes or no answer will suffice. Chairman Gensler, part of the SEC's mission is to protect investors. Does the SEC review pre-IPO documents?
I think you said pre-IPO documents. You're supposed to, if you're going to take a company public, the staff of the SEC does review those to see that they're in compliance.
Correct. Is Coinbase a publicly traded company?
I'm sorry?
Is Coinbase publicly traded?
Yes.
All right, so the SEC allowed pension funds and retail investors to invest in a company, Coinbase, that you apparently, from prior remarks, believe was engaging in illegal activity. All of their activities were laid out in their public filings in the S-1 prior to the IPO. You did say that you believe Coinbase is selling unregistered securities, correct?
Again, I'm not going to speak to any one.
No, but you said that they're selling unregistered securities. This is your public comments.
I think, with all respect, I look forward to you finding that because I'm trying to be very careful. I'm not speaking
we'll help
about
refresh
any
your
one
memory.
company.
In the Kim Kardashian settlement, the SEC stated that Ethereum Max is a security. She reached a settlement for promoting an unregistered security. The unregistered security is Ethereum Max. Have you charged the issuers of Ethereum Max for offering an unregistered security?
We reached a settlement with a celebrity, Ms. Kardashian.
Yeah, but not, she just promoted it. She doesn't operate Ethereum Max. Have you said that Ethereum Max is an unregistered security to the people that offer it?
We did in that settlement, yes, sir.
Okay, it's still trading. What about Ethereum? Is Ethereum now a security?
We had this
I heard your
discussion.
exchange. They've been in place since 2015. You say in your statements that there's clarity in the market and the rules are clear. Just come on in. You can't even answer the question. Do you say XRP is a security?
Well, we're in court and active discussions and litigation on that matter.
You're in litigation because you do say it's a security. As you know, let's move on a little bit. As you know, qualified custodian banks would effectively be unable to provide crypto asset-related custody as a result of punitive capital impact under accounting provisions in Staff Accounting Bulletin 121. Do you agree that the bulletin should be amended?
I think that the staff addressed an accounting issue and appropriately saw that crypto assets held in custody today are not segregated or not bankruptcy remote in bankruptcy and should be appropriately put on public company financials.
I wish I had time to go into the ESG rule and everything else, but Chairman Gensler, your record of failures to protect investors and abuses of power make it clear that we need to restructure the Securities and Exchange Commission. The failures are many, but let me cite some of the abuses. You average more than 2 rules proposals a month. You provide inappropriately short comment periods. You have unworkable and unlawful ESG disclosure mandates on the market. You have essentially a Hotel California rule for crypto where you can check in anytime you like, but you can never leave. You have endless discovery with no resolution and no clarity for the captives in the market. You have unworkable proposals for overhauling equity market structure, a de facto ban on crypto through proposed custody rule. You have high staff turnover, unhappy people leaving your office, and unhappy companies and capital leaving our country. To correct a long series of abuses, I'm introducing legislation that removes the chairman of the Securities and Exchange Commission and replaces the role with an executive director that reports to the board where all authority would reside. Former chairs of the SEC will be ineligible under my proposed bill. And this isn't just my take. It resonates across the political spectrum. The American people want democratic access to capital, retail investor participation. You can't just exclude retail investors from markets and claim it's for their own good. Our markets need to function and flourish, and I yield back.
The gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chair Gensler, for being here today. I know it's been long, and you're probably hungry and maybe thirsty too, but bear with us, we're almost there. As we know, April is Financial Literacy Month, so I would like to begin by touching on the SEC's financial literacy efforts. My home state of Texas consistently ranks concerningly low in financial literacy. The Federal Reserve Bank of Dallas reports that Texas's low financial literacy rates are correlated with poor outcomes on measures like emergency savings, possession of a bank account, and credit score. And even further in my district, which is 77% Latino, limited English proficiency adds an additional barrier. Chairman Gensler, I understand that SEC holds an annual financial literacy and career day for high schools that recently took place. I'd like to commend the SEC for these outreach efforts, and I would also like you to encourage the Commission to strive for more financial literacy outreach work. Can you please provide an update on the SEC's financial literacy outreach efforts and the event that took place this month?
It's a really important part of our role is to investor education, and we have an office of investor education that tries to engage in the public, also provide information on our websites so that the public can better understand. In addition, also, we take in somewhere between 2,000 and 4,000 tips, complaints, and referrals per month that the investing public knows to turn to us from time to time, as well as state regulators, when they see something and they think there's something amiss with their broker-dealers. But it's a really critical part, and I'm glad to follow up with staff to share more about what we've done in the last month, if I understand your question.
Well, yes, and I would love to see what they may be doing in Texas in particular because of our low financial literacy rate and, of course, in my district. particularly when it comes to our Spanish-speaking, and as you know, in Texas, we are under mandate for, access to the ballot in both English and Spanish, and in Harris County, my home county, it's English, Spanish, Vietnamese, and Chinese, so it's an international population, and certainly we need to make sure that financial literacy efforts are also in those languages. So next, I'd like to turn to the issue of human capital disclosure, a practice that is essential to allow investors to put their money into companies that share their values like fair wages, diversity, inclusion, worker health and safety, and comprehensive benefits. As you recall, you may know that the Republican majority dissolved the Diversity and Inclusion Subcommittee, so it is now up to the full committee to take up these issues as they occur during hearings, especially related to diversity and inclusion. Human capital management is not only essential for employees, but it's also good for business. Good human capital management has shown to increase companies' bottom lines and performance. Employees that are taken care of and are happy just perform better. Chairman Gensler, can you please provide an update on the SEC's efforts to produce more comprehensive rulemaking on human capital disclosures, and why is this type of disclosure so important?
So the staff is still working on recommendations to the full commission. I think it was in 2020, we actually updated the requirements for disclosure, including human capital disclosure. So we wanted to take a close look of how those disclosures looked in 2021 and 2022, and then based upon that, put forward further recommendations. Why they're important, it's really an important asset of many businesses. And I know even when I was young on Wall Street and I was in the Goldman Sachs merger department, if we were selling a company, the buyer would want to know about the turnover, about the compensation, about the benefits, about the employment statistics, because it's a critical asset and it relates to financial performance and the risk somebody's taking as an investor.
When do you expect to get those recommendations?
Again, I like not to prejudge the timing, but the staff is working on it to serve up to our 5-member commission. It's one of the, I think as I said earlier, it's one of the remaining proposals on our unified agenda.
All right, thank you. And I see my time's running out. I yield back my last 5 seconds.
The gentleman from Tennessee, Mr. Rhodes, is now recognized for 5 minutes.
Thank you, Chairman. I want to follow up on Mr. Himes' comments earlier and congratulate Chairman McHenry on getting you here so quickly in the 118th Congress. Chair Gensler, it's been a while since you've been here and testified before this committee, and I want to know, how did you manage to go more than a whole year and more than half of the 117th Congress without testifying before this committee?
Congressman, I've been in front of this committee under 3 presidents, under 7 or so chairs. I must say, I enjoy being in this committee room and being in front of you, but I don't know. That was up to Chair Waters at the time.
So I'm wondering, when the Democrats were in the majority, did they not reach out to you all of last year about testifying, or did they ask you to testify and you just refused or declined to come?
I stand ready. Whomever's in the chair's seat, I'm stand ready to be here.
Well, it's good to have you here. I want to shift gears a little. It currently costs just $2,000, you might say, for an individual or group of individuals to submit a shareholder proposal, obviously owning a stake in the company. Many companies have millions of investors who will each spend potentially several hours considering such a proposal to make an informed voting decision. As your agenda continues to make it easier for activists to have their shareholder proposals included on company proxies, why haven't you considered the costs that will be borne by those millions of other shareholders?
Shareholder democracy is an important part of the fabric of our capital markets and has been since Rayburn helped write these laws. And so we do take into consideration cost and benefits of the rules.
When you were justifying your decision to roll back the 2020 proxy advisor reforms, you seemed very concerned with the cost borne by proxy firms. Why was that weighted so heavily?
Well, it was only one of the costs, if I recall the analysis, but there were other costs and benefits that were weighed as well. And I think that it's really was about moving forward that they could provide that information to the investing public in a timely way, and then investors get to decide whether to vote yes or no on various proxies.
In January, I wrote to you, and joined by some of my colleagues, Mr. Stile here and Mr. Sessions, I wrote to you regarding my concerns with the new approach articulated in Staff Legal Bulletin 14L and the unprecedented low rate of shareholder proposals permitted to be excluded by SEC staff during the most recent proxy season. I'll note that you did not respond to this letter. I hope you will do so. Is it common practice for you to miss deadlines and ignore requests from members of this committee?
No, I thank you for reminding me. I will take a close look at that letter.
I appreciate that. I hope you will. Shift gears again. The SEC's proposed climate change rule, which we've discussed already today, including reporting on so-called Scope 3 financed emissions, which would require financial institutions to collect and report on the emissions activity of their customers, including privately held farms and small businesses, and even state and local municipal governments. Chair Gensler, do you think it is appropriate for the SEC to use disclosure requirements to shape access to capital for American businesses and families, or even local government entities?
Again, we're merit neutral, and the climate risk disclosure rule is only about public companies. It's not about those private non-public companies.
And I heard you say that earlier, but I guess I fail to see how you can't see that if Scope 3 disclosures are required, that those public companies are in fact going to be pressing municipalities, small businesses, small farmers for the information that is necessary for them to comply with the rule that you've proposed.
So if I can address it in two ways. One, our proposal was only that a company that said it was material to them or they were making certain future commitments, they would disclose it, but they can use estimates, they could use frameworks, they could use templates and so forth. But two, we've heard a lot from the public comment period. The public comment period helps us, and I've asked staff to consider how we can look at this to address those comments, whether it's from the farm community or small business communities across America, because we only oversee the 7,000 or 8,000 public companies. It is not a rule about the rest.
Thank you. I hope indeed we see that reflected in whatever emerges. Thank you, and I yield back.
The gentleman from North Carolina, Mr. Nichols, now recognized for 5 minutes.
Thanks so much, Chair Gensler, for being with us today. My staff tells me I'm about the 25th member to ask questions. How are you enjoying your visit here today?
I always love being in front of the House Financial Services Committee.
Well, it's been a while since you've been here, so folks are excited to hear from you. My first question involves a bill I've recently introduced, the Improving Disclosure for Investors Act with Congressman Huizenga, which would make it easier for investors to receive documents electronically. According to a recent survey, a large majority of everyday retail investors, regardless of income or age, prefer e-delivery for its environmental benefits, speed, and convenience. And businesses strongly support e-delivery because it allows them to enhance the quality of their disclosures, improves investor engagement, and reduces cost. Additionally, it's estimated that the industry sends over 27 billion pieces of paper in the mail, which my staff tells me is the equivalent of 2 million trees being cut down every year. Our bill would align the SEC's rules with my constituents' preferences, and I believe this is an issue that industry, the SEC, environmental groups, and Congress can work together on to make life easier for my constituents. I feel pretty good about this bill. I think it's going to pass. I think it's going to get signed by the president. When that happens, number one, what do you think about the bill? Do you know about the bill? And number three, will the SEC prioritize adopting e-delivery?
I look forward to actually looking at the details of the bill, but if passed and the president signs it, certainly we'll implemented according to its law. I would note, many years ago, I helped work in the late Clinton administration on the e-signature bill that then Senator John McCain led work on. So I believe that a lot that was once done in paper can be done electronically.
Thank you so much. Chair Gensler, we share the same goal of making our markets more safe, fair, and equitable. So I'm concerned that dramatic changes to our capital markets, as seen in the proposed rules on equity market structure, could have negative and unforeseen impacts on the working families in my district saving for retirement. I was happy to see the Commission pursue updates to Rule 605 data to modernize data collected from the industry, and applaud you for those efforts. This will certainly improve competition and lower prices. However, since the rules were proposed, several new academic studies have come out with evidence for two of the proposed rules that would do the opposite of what the SEC claims, increasing costs for everyday investors. Without the wholesaler system, these retail investors could lose close to $1 billion per month in additional trading costs. Any increased costs on my constituents looking to save for retirement concerns me. Additionally, I'm concerned that commission-free trading, which my constituents rely on, would go away. Have you considered constituents like mine in North Carolina's 13th district that are saving their hard-earned money for retirement, and how these proposals could increase costs for them?
Absolutely. Your hardworking constituents, I would note, zero commission does not mean zero cost. There's a lot of costs that are elsewhere also in the system. And so the other proposals about that a broker is to have a standard to give you best execution when you place an order, I believed, and we're getting public comment, that's a pretty straightforward standard to get best execution, and your federal securities regulator ought to have that in place, not just the self-regulatory organization. The other proposals are to level the playing field between what's called the lit market and the dark markets, that they have more harmonized rules and they compete for your orders. And then we've proposed something around getting better competition for individual orders of below a certain dollar amount. But absolutely, it's about trying to make the markets more transparent, more competitive for your constituents.
You know, my time is running out here, but I want to thank you for being here with us today. I think it's really important that you engage with the general public, with industry, with a number of different stakeholders in this process. My office is going to be reaching out to you later on about trying to find some ways to get folks together with you in a productive way to engage on these issues. So thank you again for being here, and Mr. Chair, I yield back.
Thank you.
The gentleman from Wisconsin, Mr. Stiles, recognized for 5 minutes.
Thank you very much. Chairman Gensler, the 2013 CFTC Inspector General report raised concerns about your use of personal email to perform official CFTC business. Have you used a personal email address to conduct any SEC business?
No, and if I ever, there are some people that occasionally, over the course of the time, inadvertently send me something, and then I just forward it to the SEC.
So you've not used a personal email address while at the SEC. Have you used multiple email addresses at the SEC to conduct SEC business?
I have 2 SEC emails. They're both on the website, both stored and retained.
Thank you very much. Do any members of your senior team or subject matter experts have digital wallets or own digital assets?
I don't believe under our ethics rules they do.
Do you own digital assets or have a digital wallet?
I don't own any crypto assets. All of my securities holdings are actually digital because they're held by a broker-dealer and they're digital there.
Have you ever owned Bitcoin or another digital asset?
No.
And so maybe here, I'm guessing most folks on your senior staff, I'm guessing you included, have bought or sold stocks, but none of them have owned, or none of them currently own crypto assets, but are in the process of making rules and regulations on crypto assets. That'd be a fair assumption.
I couldn't speak to that. I actually at MIT taught a course called Blockchain and Money. I taught multiple courses called Crypto Finance and other courses as well.
But you didn't own any crypto? You taught the course, but you weren't a user in the product.
I did not own crypto assets. They're a highly speculative asset.
No, I'm not asking for your view on it. I'm just saying that you're in the business now of making rules and regulations regarding digital assets, but you've taught a class on it. You've never personally owned a digital asset, any crypto, including Bitcoin.
The only digital assets I have is my bank account and my brokerage accounts, but no crypto.
Very good, thank you. On July 13th, 2022, the SEC proposed amendments to Rule 14a-8, which would make it harder to exclude duplicative proposals. According to a recent analysis, shareholder proposals increased 8% last year, a lot of them ESG related. Do you agree that this proposal will burden shareholders by increasing compliance costs? Yes or no?
I think it will benefit shareholders
But will it
enhance shareholder
But will it
democracy.
increase, the question is, will it increase compliance costs?
We put out to public comment and economic analysis includes both the cost and the benefits.
Understood, but is there a cost associated with that? Is there a compliance cost?
Sir, I'd have to get back to you as to what we put out in that.
Well, I
proposal,
would
but
know.
I believe
that's
that
fine. The proposal acknowledges the fact that it increases compliance costs, and Commissioner Ueda argued in a statement that this proposal is, quote, one more reason for not becoming a public company to begin with. Do you then disagree with your commissioner's comment?
We have lively and good debates, but I do think that shareholder democracy is part of our U.S. capital system.
Understood. I would be concerned about the increasing compliance costs, and that this burden upon burden upon burden is a reason we see fewer companies going to the public markets in the United States. Let me shift gears. Last summer, the SEC released a request for comment looking into whether or not index providers should be considered investment advisors. I've not heard this concern or this complaint from anyone. Did anyone come to you and ask you to investigate this issue?
It's a policy initiative that has been in front of the career staff at the SEC for a number of years, and so we thought we should get public input. This was just a request for comment, not a rule proposal.
So understood that it's at that stage, but I think it's concerning where the concern is that some of these fishing expeditions have a substantive and material compliance cost for companies unless there's a substantive risk that you're identifying in this space.
Here's the substantive risk. If you're included or excluded by an index, there is a lot of economic and academic research about what that can affect the stock price or bond price and being in and out of an index. So that being in an index itself is pretty important to those issuers. And so then who are the index creators, providers, and how are they regulated?
Thank you for your feedback. I know I have to yield back. I'd say I also have concerns on your proxy advisor position. Mr. Chairman, I yield back.
Thank you.
The gentlewoman from Colorado, Ms. Pedersen, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and nice to meet you. We've never had the opportunity to say hello. I'm new to Congress. I come from the state legislature, so I'm still not used to how differently committees run. You're gracious in saying that you enjoy being in front of us, but the good news is you're almost done. But thank you so much for being here today and explaining to the public the important role that the SEC plays in ensuring the American financial system remains strong. April is National Financial Literacy Month, and it's something that I know has been highlighted by Congresswoman Beatty and Congresswoman Kim. The theme this year is investing for everyone. This issue was brought to the forefront during the GameStop issue that this committee was heavily involved in nearly 2 years ago. Since that time, we've seen the amount of retail investor participation remain high at 20% relative to the previous 10% a decade ago. And one of the more important purposes of making investing accessible is to build generational wealth. Investment products, many of which are overseen by the SEC, are what comprise many typical Americans' retirement plans. By helping teach individuals the risks and rewards of investing, the SEC can help individuals, particularly from marginalized communities, who can potentially access long-term wealth. Can you talk about some of the successes of the Investing is for Everyone campaign and also talk about how the SEC is working to educate new investors.
Investor education, as I mentioned earlier, is very important, and we have an Office of Investor Education and reaching out to the public. We also have a really important piece of it beyond investor education. If people see something that they feel that's a problem, tips, complaints, and referrals to come into us and let us know. I know that I also try to use the platform of being a chair and speak to the public, whether it's through social media or other means, to try to take what sometimes is complex issues and make it more digestible for the public.
I was also really impressed with the website and all of the tools and information that's given for the public to be able to utilize. I know that this has been covered extensively, but I do think there are fair points to be made regarding how the different rulemakings could interact with one another and the short time that has been given for public feedback. How can you reassure the public that these changes to the markets will not significantly impact their retirement savings accounts or children's college funds or any other investments that they've made?
Well, I think our whole mission, our whole goal is to help both issuers and investors. And you asked about investors, but it's really about lowering the cost of the markets in the middle and making sure that that market works for them, and then they're not just working for the market. In terms of comment periods, I would note that we put out to public comment reforms of our stock market, and they were out for 3.5 months for comment. We've gotten 3,000 to 6,000 comments on each of these rules, so whatever that adds up to, nearly 20,000 comments. But we continue to take comments as they come in.
Great, thank you for that. I know it's a concern that I've heard throughout the financial services community. So we've talked about something that I want to cover, and I'm almost out of time. It goes by quickly. I want to discuss a topic that you've briefly mentioned in your testimony and that you have a background in. Players in the financial sector have traditionally sought to use advanced technology and analytics to get on the edge, the cutting edge of their competitors. The rapid growth and expansion of artificial intelligence has the potential to revolutionize many sectors of American life, but also bring new challenges. The White House, in October 2022, the White House Office of Science and Technology Policy published a blueprint for the AI Bill of Rights, which shared a roadmap for the responsible use of deployment of AI. As the committee has covered, the strength of our markets are central to the strength of our country. Bad actors utilize AI, or even a zealous AI system, have the potential to disrupt markets in ways that we have not even fathomed yet. What specifically should Congress consider as we potentially look at developing a regulatory framework for AI?
I thank you for asking. It's much more transformative than anything we've discussed about crypto, with all respect to that.
And now we have 10 seconds.
But I really think that it's going to bring great progress for the country. We're looking at it as in terms of the conflicts in robo-advising and in brokerage apps and the conflicts that are there, potentially.
The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and Chair Gensler, thank you for being here today. The SEC currently has rules that aim to prevent market participants from trade front-running. These rules help to protect retail orders from having the price move against them due to a participant trading ahead of the order and impacting the supply and demand for that security. Do you agree that such a prohibition plays an important role in helping protect retail investors?
I do think that rules against front-running help individual investors.
Thank you for that. But under the auctions mechanism that the SEC has proposed in December, detailed information regarding the characteristics of a retail order would be publicly announced prior to that order being executed. In practice, this would allow participants to use that information to legally trade ahead of the retail order. I find this astonishing. Do you agree that the ultimate result of the SEC's auctions rule would be legal front-running with prices moving against retail investors?
I understand your point, but I think that actually it could benefit investors and be part of a critical structure. We have auctions in the options market. We've learned from that. Those are and look to see whether to have something and build on that in the
Given-
cash markets.
Given your repeated statements on the need to protect retail investors, it is shocking that the SEC would issue such a proposal. I believe it's clear that the SEC should not move forward until a proper impact analysis can be conducted. Furthermore, as highlighted earlier by Congressman Lucas, there is substantial evidence to show that the SEC rushed this proposal without considering the real-world impact on the investing public. Moving on to rulemaking, the SEC's recently proposed rule on third-party vendor due diligence for investment advisors is concerning because it seems that the Commission again failed to consider the real-world impact. The reality is that the broad scope and significant due diligence obligations required as a result of this rule would force many small to medium-sized vendors out of their respective markets and push their clients to a few larger vendors. Many of these businesses don't have the capacity or resources to comply with the unnecessary and overly burdensome obligations. Are you concerned about the potential consolidation that could happen and subsequent risk that consolidation creates if there is an over-reliance on a small number of vendors?
I think we've already seen that in the markets, that there's a great deal of consolidation about outside service providers
But
to
we
the
shouldn't,
investment
we
advisor.
shouldn't facilitate that. That's not good.
So we already live in that ecosystem. What we're trying to do is ensure that the investment advisors relying on those service providers still do their role and comply with the laws and do due diligence on use of those service providers.
I have one final question, and I got to be honest, I don't know how you're going to answer it, so I'm kind of excited. But the fact that I don't know
I'm
how to answer it,
excited just listening
the fact
to
that
the
I don't know
question.
how you're going to answer it is actually really concerning. So in 2014, Jared Bernstein published an op-ed in the New York Times titled "Dethrone, quote, King Dollar," where Mr. Bernstein advocated for the U.S. government to actively take steps to remove the dollar as the global reserve currency. President Biden has now nominated him to be the head of his Council of Economic Advisors, all while the Chinese are actively undermining the dollar as the global reserve currency, and their successes are increasing both in number and at an ever-increasing rate. So, Chair Gensler, you have been in and out of government for 25 years. As well, you have ample experience on Wall Street. Do you agree with Mr. Bernstein that the U.S. government should take steps to actively remove the dollar as the global reserve currency?
I'm not familiar with the op-ed, but I think that we've benefited as a nation that the U.S. dollar has had such a central role since actually a little over 100 years now.
So no, you do
And
not think that we should actively take steps to remove the dollar as the global reserve
I'm
currency?
going to go a little further. I think a lot of our agenda at the SEC is about ensuring that we go as many years, as many decades as possible, that we have the best capital markets. And I think the best capital markets undergirds our geopolitical standing and helps our dollar be the leading currency.
We agree.
Around the
I really appreciate that. It's disappointing that the president is nominating someone that disagrees with both of our positions on this. I guess just real quick, if we do lose the dollar, the cost of import goods will skyrocket because foreign companies will no longer want dollars. We'll lose our ability to borrow at current levels. Inflation will be higher than it already is after spending trillions of dollars we don't have. Interest rates will rise. It'll crush the real estate market. All of that is bad, but even worse, our interest rate on our $32 trillion of debt would go through the roof. President Biden has nominated somebody that thinks that we do not need to have the position we have in the world. Thank you, Mr. Chairman. I yield back.
The gentleman from Nevada, Mr. Horsford, is now recognized for 5 minutes.
Thank you to the chairman and ranking member for your leadership, and thank you to Chair Gensler for appearing before the committee. The sophistication and sheer size of the United States capital markets could not be possible without the competence and information provided by a strong Securities and Exchange Commission. Investor protection is paramount, and it is worth reiterating that as a result of the SEC, you've helped return hundreds of millions of dollars to defrauded Americans each and every year. Your consumer protection efforts go beyond enforcement action to ensuring that every investor has access to the same timely, accurate, and complete information required to participate. So I applaud the Commission's work around facilitating capital formation for U.S. markets, maintaining fairness and efficiency in those markets, and especially your strong stance on protection for Main Street investors. Now, I know that having 3 pillars to your mandate can also create tension between differing objectives. However, I want to urge you to keep in mind that for many of my constituents in Nevada and many all across this country, their main interaction with our vast financial system is through their retirement plans. For example, I commend the vision of consumer protection inherent in your open-end fund liquidity rulemaking, and I also agree that net asset value should be considered as a way to shield general shareholders from ending up on the losing side of a first-mover advantage. However, as I understand it, this proposal would require open-end funds to implement a hard close at 4 p.m. Eastern Time. Upon first glance, this deadline doesn't seem too onerous. However, in Nevada, my constituents, retail investors, often make their investments through intermediaries such as 401k plans and other retirement accounts. These hardworking Nevadans who aren't able to submit their orders directly to the fund would need to submit their orders to their intermediary hours beforehand, potentially as early as noon. So I don't think I have to remind anyone here, but that would mean constituents in my state would miss out on today's price if they can't get their trades in by 9 a.m. Pacific Standard Time. So Chairman Gensler, what would you say to investors who worry that a hard close will lead to a bifurcated market where sophisticated investors will be able to utilize more information and lock in the day's price while others are forced to trade early in the morning? And additionally, do you see ways to mitigate this disadvantage for West Coast investors while still implementing a swing pricing proposal?
It's what I would say to the constituents is that we have a system right now that open-end funds and money market funds work really well for them during normal times, but in times of stress, which we have every so often, we've had to rely on our Federal Reserve and other means to sort of support them from time to time in the 2008 crisis in 2020 and so forth. And so what we're trying to do is find a way that those funds are less reliant on potential extraordinary measures by our central bank. And that's really what we're trying to do. And so there's a bit of plumbing, it's a bit of infrastructure behind the scenes that when you and I think we're putting in an order by 4 o'clock Eastern Time, or I guess 2 o'clock.
1 o'clock.
1 o'clock, so it's 3 hours difference, thank you. 1 o'clock Nevada time, that actually it's going to a retirement plan servicer, and then they're sending it, and we're trying to address and work.
Which adds to the complexity of what I'm raising, which
Right.
is why
And
I think it creates a bifurcated.
adds also to the challenge of the systemic risk issue that those fund managers may currently not know until late that evening or even the next morning what redemption requests they have.
Well, I'd like to work with you on that. I'm concerned about a two-tiered system. Let me just point out for the record, all 3 major credit rating agencies failed to forecast the existential risk that both Silicon Valley Bank and Signature Bank faced. And it's too late, in my opinion, to change ratings after an institution fails. So I hope that you would assess the performance of the rating agencies and determine what the root cause of the inaccuracies was in their ratings. I think that's very problematic and something that needs to be addressed. I know there's a lot of oversight with your agency, but this is something that should reach priority
The gentleman from Pennsylvania, Mr. Muser, is now recognized for 5 minutes.
Thank you, Chairman. Chairman Gensler, I am concerned about the SEC's proposed rule on swing pricing and how it may affect retirement plans. Many people think it is a rule in search of a problem. Have you consulted with the Department of Labor to do a study about the cost of this requirement, what it add for retirement investors?
I know that we've discussed with the Department of Labor other rules, but this rule, I'd have to get back to you, sir.
Well, we would very much like to see such a study. This rule is, in fact, negatively affecting the financial future of nearly 2 million workers in Pennsylvania. So if you would, that would be great. Also, Chairman Gensler, I have grave concerns about how the SEC has handled its review, particularly high-profile S4 registration statement. I would like to start with concerns about potential conflicts of interest related to this S4 review. You were the CFO of Hillary Clinton's 2016 presidential campaign, and as campaign chairman John Podesta testified under oath in 2017, you were ultimately responsible for funding the very discredited Steele dossier. Additionally, senior SEC enforcement official Melissa Hodgman is the spouse to former FBI agent Peter Strzok and SEC General Counsel Megan Barbero has worked on 2 impeachments of the former president. However, neither you nor Ms. Hodgman nor Ms. Barbera have recused yourselves from the following. In May 2021, Digital World Acquisition Corporation, DWAC, filed a registration statement for its merger with Trump Media and Technology Group, TMTG. For nearly a year, the SEC has obstructed the merger, destroying billions, I said billions of dollars in shareholder value, and harming over 20 million individual retail investors the SEC is chartered to protect, including many of my constituents. The average processing time for an S4 form, which you well know is the last step in the merger like this, in 2022 was 134 days. Before your term as chairman, it was under 100 days. As of today, the DWAC has waited 337 days for the SEC to begin processing this form. This seems clearly out of the ordinary, correct?
The review of these forms, the merger forms, when a special purpose acquisition company is buying a company and that company is going public, are reviewed by our Division of Disclosure Review. And yes, it takes time to make sure that those filings are accurate and in compliance with the law. And we certainly had more of them in 22 than 21. You talked about the lengthening of that time.
I'm focusing on this one, 337 days. Why should my constituents not be concerned that this out of ordinary delay is caused by such conflicts of interest?
There's with all respect, there's no conflicts here. This is just a matter of making sure that filings with the Securities and Exchange Commission accurately have the full, fair, and truthful disclosures in those documents.
Of course. Will the SEC ever approve the DWAC-TMTG merger?
We don't have a role in approving or disapproving mergers. What we do have a role of overseeing the disclosures with regard to those mergers, and it's really just the disclosure documents review.
Okay. What concerns should my constituents have that are shareholders in this very unordinary extended review process?
I would say
they shouldn't have any concerns, or they should have serious concerns because they're losing money.
Overall, again, not speaking about any one circumstance, but overall, investors benefit by robust review by this. It's about a 300-person unit that looks at these documents to see whether they're complying with the law and they're accurate. Okay. And yes, from time to time, we actually take an order. A 5-member commission takes an order to investigate further. It's called an 8E order.
I'm familiar with that. I want to get to that. But stable roads, for instance, you were very familiar with, very similar at procedural parallels to all of this, was bragged by Ms. Hodgman about incredible speed, efficiency, and creativity. It was able to move forward even while under added investigation. So what was the legal basis for refusing to process a registration statement based upon the existence of the so-called 8E examination? What's the legal basis for it?
Again, I'm not speaking about any one circumstance, but Congress gave us authority under the 1933 Act that I talked about earlier, that Sam Rayburn fathered, and to make sure that the disclosures to the public are accurate and complete.
Can this organization expect some sort of response from the SEC any time in the near future?
Again, we work with registrants to make sure that their filings are accurate and complete.
Thank you. I yield back, Chairman.
The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you, Chairman. Chair, thank you so much for being here. You know, climate disasters cost us money, right? Like climate disaster, does it cost the economy money? Is there an impact on the economy?
I mean, there's a lot of economic research that shows that.
Oh, it's a pretty simple
that climate risk has led to cost to the economy.
Like the disasters that a lot of my residents talk about. I mean, somebody's paying the cost to clean it up. I know like in Michigan, we've had several, I think since 2020, I believe we had like 11 different climate disasters, which resulted in about $2 billion cost. So it costs money when we have these climate disasters.
There's weather events, there are other events that can occur.
When you all put the rule out in regards to, and I'm going to talk about Scope 3 emissions, there was overwhelming support in the comments, correct, by investors for the proposed rule?
There's generally been strong support amongst investors. There are some that are in opposition to what so-called Scope 3 disclosures, but generally very strong support, far more mixed on the issuer side.
Actually, Chair, I read that 97% of investors supported the proposed rule of all the comments submitted. So I want to talk about what is Scope 3?
So one of the ways that investors have thought of to understand the climate risk of the companies they're investing in is their greenhouse gas emission. And then there's so-called emissions that are from the company itself, Scope 1, from the electricity they buy. And then there's this concept called Scope 3, the greenhouse gas emissions of their suppliers and their customers.
Which is really important. In European Union, don't they require some sort of disclosure around this already? And about 70% of public companies in America have to report to them in regards to that. I think they call theirs, if I'm not mistaken, Corporate Sustainability Reporting Directive. But I don't, do they have like a Scope 3 emissions disclosure?
So the European Union's disclosure directive is, I believe, being finalized and going into place sometime this summer. But from public reports, yes, they would be covering.
70% of US-based public companies, correct? Would have to report.
So their regime in Europe says that if you operate in Europe, or you're listed in Europe, or you have over 150 million euro of you're covered. And the Wall Street Journal recently reported that it would be about 70% of US companies would meet that European standard.
However, despite the importance of this, and I mean, I think folks generally outside of Congress generally are very supportive of this proposed rule. Companies, though, under Scope 3 would have to determine what they think is important to report. Is that correct? It'd be up to them.
What we proposed is only about public companies. It's not about their suppliers, but the public company would be required to
You're not worried about underreporting? Because the way the threshold is, it literally only requires disclosure of Scope 3 emissions that they themselves determine to be important. I mean, I can go into details in showing you when you say things are illegal. No one ever talks about the fact that there is a huge trend within these public companies of inside trading, of violating the law. I mean, enforcement is a different aspect, but
you're right.
I'm worried about underreporting here.
Yeah, what we proposed was that those companies that found it so-called Scope 3 was material to them, that then they would have to report it.
Chairman, I'm really concerned at us allowing them to decide. I mean, just look at Silicon Valley, even, and I'm so glad that Congresswoman Velasquez mentioned Section 956. I mean, the fact that it's been 12 years that we don't even have this, we can't even claw back. But we know for a fact from timeline, certain companies do certain things for profit, even though it's against the law. And I just feel like very much when we allow this much kind of let them decide whether or not it's important to report, I'm really concerned about underreporting regarding the emissions impact. And I just want you to go back to the rest of the commission and express the concern here. You can't allow them to self-determine what's important. I think we need to tell them what it is.
Thank you.
The vote's been called on the House floor. The chair's intention is to get through as many of these questions as possible Then we will recess for the purposes of these two votes on the floor. I'll quickly come back. We'll restart the hearing as soon as we have bipartisan attendance, and then get rolling here. Mr. Fitzgerald of Wisconsin is recognized for 5 minutes. I think we'll have time to get to Mr. Vargas next in the queue on the Democrat side. And then Ms. Kim, if we have time.
Thank you, Mr. Chair. I'll be quick. This was a question that Congressman Lukenmeyer had touched on earlier, and it's something that's been kind of a running theme, I think, as we've had the Fed and others come before the committee. So sustainable home ownership is obviously a mechanism for young adults to try and get into the market and build wealth. However, access to affordable home ownership, it's increasingly out of reach in many communities across the country. And so I've been trying to put this on a lot of people's radars so that they can kind of watch and hope to usher things forward. So 65% of Wisconsinites, our first-time home buyers, have used private mortgage insurance. And without the tool, based on the median income and the median home value, it would take the average Wisconsin family about 10 years to save the 20% it would take for a down payment. In January, at the end of January, the SEC reproposed a rule regarding the prohibition against conflicts of interest in the certain securitizations, which you're aware of. So the whole idea of the synthetic asset-backed securitization, I think, is what a lot of members have been focused on. So my question to you is, we feel like that the rule could be overly broad and ambiguous, and it could prohibit private mortgage insurers from procuring not only reinsurance in the capital markets, but just over the ordinary course of the U.S. regulated insurance businesses. It could tighten it too much. And I'm just wondering kind of if you guys are in tune to that. We are very concerned that, young adults between the age of 25 and 35 are going to miss the opportunity for this first-time home ownership, and we're not sure how that's going to how we're going to recover from that.
I appreciate your raising it. It was a recent proposal, and so I haven't gotten a summary yet what's in the comment file, but in terms of this, I think what Congress addressed, and we're doing this because it was mandated by Congress, that people in the asset securitization markets, this is mortgage markets that are securitizing it, in the 2008 period had some conflicts that were revealed, and Congress said we had to address, to ensure to make sure, address those conflicts. And so we're trying to follow up on Congress's mandate that we're required to do that, but I'll certainly take this back.
Yeah, and once again, I'm putting it on your radar. I think it's a running theme. It's a big concern, I think, for many members of financial services. So, but thank you for your time. I yield back.
We'll now go to Mr. Vargas of California for 5 minutes.
Thank you very much, Mr. Chair. And again, I want to thank you, and I want to thank the ranking member for convening this meeting. And I can see why you cherish the experience, Mr. Chair, of coming under 7 different chairs. And I imagine you could name them all if you were asked to do so. No, don't look. Don't look. That's cheating. That's cheating. But anyway, I jest, of course. And again, I thank you very much. Now, I was going to go into a whole bunch of questions here and praise you over, because I'm the co-chair of the Congressional Sustainable Investment Caucus, and what you're doing, I think, is fantastic. And again, I appreciate it. But you kind of dropped the bomb on us in a second there. You said something, and then you didn't get an opportunity to talk about it, and that's AI. You said, with all due, and I don't want to put words in your mouth because enough people have done that today, but you said something like AI is really what's going to be much more transformative, with all due respect, to crypto or these other things. You said something like that, and then you stopped. Could you elaborate?
I truly believe it. I think it's as transformative as the internet itself. It's going to affect all parts of our economy, whether it's radiology, whether it's driverless cars. But in finance, it's already being adopted. It's being adopted for call centers, for compliance. robo-advising, brokerage apps, something called sentiment analysis, where even this hearing right now might be being fed right into a sentiment analysis to analyze, and would the markets go up or down depending upon what the chair said. This is Chair McHenry, not this chair.
Yes.
You know, and
You'll have a picture up soon.
yeah.
Very nice.
It'll probably be life-size, actually.
So it's transformative, but it's also raises public policy issues, and one of them that we're looking at the SEC is using predictive data analytics in robo-advising and in brokerage apps. Are the applications just solely looking at the interest of the investor, or are they also looking at their own interest, and that might inherently have conflicts in the algorithms?
As liberal as I am, I'm actually conservative in the way I look at the world. When there are changes, it makes me a little nervous. So for example, when we take a look at risk for insurance and we take a look at zip codes, other things other than the person's driving experience, miles driven and all that, it makes me a little nervous. So when you get into AI, especially how it's going to affect poor communities, people of color, and that concerns me. Does that not concern you?
I think it's a big challenge because, look, I mean, right now you can sweep the data up from your automobile driving. It's called telematics. You can sweep up your social media usage and sort of, based upon that, decide how to underwrite and make a loan. There's research, actually, interesting research that shows that if you capitalize your letters for pronouns in your emails, you're better credit than if you don't. I'm giving it away a little bit. And if you charge your phone every night, you're better credit, believe it or not. So now, what if it happens to be that people that capitalize their letters are of a certain race or ethnicity or gender, and it has nothing to do with credit, but then we're embedding something into the systems which has inherent biases. So yes, I think you're right to have that consideration.
Okay. I know that we're pressed for time, so I'm going to go ahead and yield back, and again, thank the chair.
I thank my colleague. Mrs. Kim is recognized for 5 minutes.
Thank you so much. I know we're rushed with time over here, but I have to say that in my ongoing conversations with those stakeholders in the financial industry, there are some things that they raise as concerning, and there is a theme here, and that is the frantic pace, limited comment periods, and complexity of the rules proposed by SEC under your leadership undermines the SEC's long-established three-part mission to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Persistent inflation is eating away the hard-earned savings of retirees, and now some of the proposals by the SEC will make it harder to save for retirement, and this is unacceptable. And so I echo Representative Horsfield's comments about the hard close rule that would force investors to put in orders to purchase or redeem funds as early as 10 a.m. Eastern Time in order to get that day's price. As a member of Congress who represent California, this is concerning because my constituents may have to place orders way before they're getting out of bed. So I just wanted to echo that comments and share that. So do you believe that creating second-class citizen of investor is fair for my constituents or constituents who are asking for a level playing field?
It's actually trying to help them out and level the playing field to protect them, because it's the biggest institutions that are sometimes anticipating that the Federal Reserve will come to their support. And in times of stress, open-end bond funds have made such calls to the U.S. Federal Reserve, and that's what we're trying to address. Those
Thank you.
implicit
I know you addressed that issue in Representative Halsford's question, so thank you. I know you're repeating that too. But let me get to the next issue. According to your SEC's Office of Advocate for Small Business Capital Formation, a woman founder's share of funding in the private markets, specifically venture capital, remains a fraction of the overall capital raised. One way to reduce this gap in funding is by incentivizing more women fund managers in the industry, something I heard in my conversation and roundtable discussions I had with them. The SEC's private funds proposal restricts site letters, and it would raise barriers to entry into private markets and disadvantage new fund managers raising their first funds. So have you assessed how moving forward with this rulemaking will inhibit new and emerging, especially women, fund managers from raising funds?
I think this rule proposal, if adopted, would really help a diverse array of investors. Those are the investors behind the pension funds that are in here, and help a diverse array of small businesses. It would potentially, frankly, lower the profits of the middle. That's the efficiency. Competition would drive greater efficiency in the middle of the market, the asset managers, and I would imagine they would comment to you that they might have lower potential profits, but that's going to help investors on one side and small businesses on the other side, raising money from those private funds.
Thank you. Thank you. Thank you for your comments on that. I want to make mention of the Commission's ABS conflict of interest rule. As you know, there are many Americans who can save up to 20% down payment on a home. But private mortgage insurance allows them to get into a home in a fiscally responsible manner. And it's especially critical in Orange County, where I represent, which has some of the most expensive housing stock in the industry. Whopping 72% of first-time California homeowners use private mortgage insurance. So will you ensure that private mortgage insurance can continue to utilize the capital markets for transactions that are recognized by state regulators, FHFA, and the GSEs being important tools for prudent risk and capital management in today's housing market? Obviously, I'm talking about the working class and middle class Californians that I represent. They agree that PMI would be needed to give them the access to home ownership. I want to get your thoughts on that.
So as the discussion with Representative Fitzgerald earlier, I'll take this back and think about it, but we have to comply with the law passed by Congress that addresses these conflicts in the market.
If you'll please provide that in writing.
Thank you.
Thank you. Thank
Will
you.
you please provide that in writing?
Yes.
Thank you. We'll go to Mr. Green for 5 minutes, and we'll adjourn. We'll recess so members can finish questioning.
Thank you, Mr. Chairman. I thank the ranking member as well, and Mr. Chairman Gensler. Given that we're into a countdown to default because of my Republican colleagues and their failure to permit a vote on legislation to lift or suspend the debt ceiling so that we might, the richest country in the world, pay our bills, the hearing should really be about, in my opinion, the adverse consequences of the richest and most powerful country in the world failing to pay its debts because of politics. And questions to be answered would include, what will the adverse consequences of default be on auto loans, things that impact a good many people, mortgages, the stock market? What will the adverse consequences be on our $100 trillion capital markets, the largest in the world, I might add? The adverse consequences on the dollar as a global reserve currency. And what are the likely adverse consequences on our need to attract investors to our treasuries in the event of a default? Of course, a question of paramount importance would be, what is the likelihood of a Republican recession? So, Mr. Genslers, let me ask you, please, as it relates to our global reserve currency, a default, what do you prognosticate the consequences to be on our status with our global reserve currency?
Representative, it's hard to predict because we'd be in uncharted waters, but it'd be quite disruptive. The base of our markets is U.S. Treasury, and you would envision that there'd be more risk in that market, less liquidity, and that it would cost more as taxpayers to raise money. In terms of the U.S. dollar, how it probably would be in more volatile times, but what would happen to its rates is hard to predict. But in terms of homeowners and the capital markets, we'd be in for a lot of volatility, and we would take a hit in terms of future investors thinking about our capital markets in the same way. They'd have to price in the risk of this instability potentially happening again.
This is a good segue into the question with reference to the adverse consequences on the need to attract investors to our treasuries. Our treasuries are considered the best in the world. People believe that their money is secure when it's in an American treasury. What would be the consequences?
Again, it's hard to predict, but it'd be quite disruptive, quite volatile, and uncertain.
I thank you for your commentary and would close with this. It seems to me that we should understand the importance of suspending or lifting the debt ceiling such that we don't get into these uncharted waters. Because once we're in these waters, we may extricate ourselves, but the impact, the adverse consequences can be something that can last for a moment. And I'm using a moment in a rather loose way because it could be much longer, obviously, than a moment. And I would hope that as you make your commentary to persons in these meetings that you have with them, that you would let them understand to a greater extent than we might share in the public our position with the reserve currency and the impact. There is a war for currency supremacy, and currently we're winning, but we don't have to have this esteemed position forever. It can change. Your final comment.
I think you're correct, and it's what I was trying to say to, I think it was Representative Timmons earlier. Part of our agenda is trying to ensure that our capital markets stay the most efficient, most resilient, and fair, so that we stay the destination of choice.
Thank you, Mr. Chairman.
We will now reconvene immediately following votes. The committee stands in recess.
Okay, folks, that was a very interesting, I guess, testification. Sorry if you can hear my cat sneezing in the background. I think there was a lot of good points made from the specific congressman, which is Mr. Davidson, and then Mr. Emma, they're both congressmen. They brought up some good points. They raised some really good stuff. So we'll be breaking that down in a video later on this evening and trying to, because what you're seeing there is how the SEC feel and how they're approaching things, and then how Congress feel. This is really important to the whole global crypto situation. So hope you folks got some useful information from there, and we will catch you in the next one. Stay safe, folks. None of this has been financial advice.